All right, team. Happy Thursday. I'm going to do my best from a production side today. Of course, it's just another terrible day in mortgage rate world. Yesterday wasn't too bad. Wasn't able to make a video yesterday, unfortunately, but essentially what happened was we came up to this prior support level here. You see that happen so many times, and then it got aided again, and the downtrend should probably continue from there. These are mortgage bonds, by the way, and so when these go down in price, that means mortgage rates go up, and so that's why we're hoping to see higher mortgage bond prices, but that's not what's going to happen. And I've been warning you about this for some time, to expect that rates are going to go higher, to plan for it. So the big question that I've been getting is, how high are they going to go? What should we expect here? Well, let's just do some simple math. We have updated data. This is 1 year. This is mortgage rates for the last year. Let me get myself out of the way. Okay, this is mortgage rates for the last year. And you'll see if you go back, okay, just 1 year, 3.17. And now, as in this data is trailing by a week. So it came out today, comes out on Thursday for the prior week. And it's all different types of loans. So this is FHA, VA, conventional, everything that's reported, which is basically everything that's not hard money. For residential financing, 4.42. So 4.42 is the average rate last week. And again, this week it's going to go up. So when we get the data next week, this number is going to be even higher. And that trend is going to continue for some time. So in the last year, we've gone up let's call it 1.25%. I think that's almost exactly what it is. 1.25% according to the St. Louis Fed here. And their source for this data, by the way, is Freddie Mac. So 1.25% in, let's call it 3 months. Let's be conservative and call it 3 months. So what if that trend continues? Where are we going to be at? Well, by the middle of the year, that would have us at about 5.6%. By the end of third quarter, that would have us at almost 7%. By the end of the year, that would have us at somewhere around 8+%, 8.25%. Now, you might say that sounds crazy. There's no way. But, I mean, when was the last time you saw a trajectory like this? Is there anything that's going to stop this? The only people who can stop it are the Federal Reserve, and they have specifically said that they are getting out of the way. So when we talk about the potential, when I said most recently, my most recent video was this real estate market is about to be tested, it takes a little bit of time for this to flush through the system. So what phase are we in right now? My personal prediction is that we're going to see 6+% mortgage rates, probably 6.5%. I bet you we'll see this get to 6.5. If we continue on this trajectory, we'll be at 8+ by the end of the year. And that will be enough to hurt the real estate market. That's enough. 6.5 might be enough. But my guess is more likely, let's see, do I have the whiteboard up? My guess is more likely, we've been watching real estate values kind of do, they basically have been doing this. And I'm going to go through this today. We're going to cover a bunch of stuff today. Why is this not working? I've been kind of doing this, right? And I think we're finally at a point here where interest rates are going to cause a consolidation. We're going to see prices kind of do this for a little while before things settle in and inflation gets settled and we're able to see rates normalize and bonds normalize before the next leg up. That's my guess. Now, some people are saying, no, it's got to come back down here first before we can head back up. And that's also possible. It's possible. And the higher rates go, the more possible the downward scenario becomes. And so that's kind of what we're all waiting to see. And we're going to look at some of this data in detail right now. And we're going to keep tracking this because one of the nice things about real estate is it doesn't sneak up on you. If you look at all of these real estate markets, it's very easy to see what's going to happen far ahead of time. And so right now we're watching these things unfold. We're watching rates spike. It's probably going to be, in the world of rates, a temporary spike, meaning it maybe it will last a year, 18 months or something. But it doesn't look pretty. And like I said, the only people who can really fix it have said they're not going to. That they're actually going to get out of the business of fixing it, let the natural market take over. So with that being the case, we have to we have to look at this very carefully. I'm going to show you some data here. Right now, okay, so what phase are we in right now? Let's pull some data up. Right now, we are in the phase where there's a rush because everyone knows that rates are going up. Everyone knows that this is happening. It's in the news. Mortgage rates keep climbing. Homes are made more expensive for both renters and buyers, and that's a whole nother topic. And I've covered the renter topic a few times recently, and we're going to continue to cover it because that does play a role in residential real estate. You are a part of the real estate market, whether you know it or not. Whether you're a renter, whether you're a buyer, you are participating in the real estate market. You are fueling demand for one or the other, and they do feed into each other. So people are seeing this. Mortgage refinance demand plunges as interest rates spike higher. The reason I point these articles out isn't because I don't think you believe me. It's because I want to show you that there is a tremendous amount of marketing being done on behalf of rates being higher. Whenever that happens, imagine if you wanted to market the fact that rates were higher. No one wants to do that, right? Only people want to market the fact that rates are lower because no one makes money when rates go higher. Do they? Right? Okay, I'm not going to go down that rabbit trail. But the point is, tens of millions of dollars worth of marketing is going out to the public telling them that rates are going up. I don't have to explain this to anyone anymore. People call me and they go, I know rates are going up. So they're doing a good job. The word has gotten out. So what happens when the word gets out? When the word gets out that rates are going up, people rush in two directions. They either say, hell with it. We were already at our wit's end. We can't take it anymore. We're going to exit stage left and we're going to figure something else out. We're going to rent, or we're going to live with mom and dad, or we're going to do something else. My buddies have an ADU. We'll go live with them. They're figuring out something else. The other group is going to jump in hardcore into the real estate market, get off the fence, start writing those really strong offers, start going all in, and they're going to look to get a home. And right now, that's where we're at. We're at the frenzy stage that's caused by rising rates. And I told you this would happen months ago. Like I said, the stuff that's happening, it's not, you don't need a crystal ball. This is just how things work with real estate. It's always worked this way. When rates spike, demand spikes initially. Everyone wants to get locked in before it's too late.
Check, please.
And so there's a rush. That's what's happening right now. My team has put a weekly record number of escrows, new escrows in this week. So the rush is on. So the question really is, well, when the rush is over and the people who exited are out, what happens then to demand? Will there just be enough demand to keep us sort of where we're at? Will sellers start to go, you know what? We're still in the profit if we sell here. Let's just get it off the books. When will there be more inventory than there is buyers? I still have a hard time believing that that's going to happen, but I'm sitting here I'm truly being pessimistic, and I can't find a lot to be pessimistic about except interest rates. And what is this going to do to the market? So let's see what's happened here. Let's look at some of this information. There's gold in here. Okay, this Altos research is brilliant. You can drill this down really far. You can go houses, condos. We always look at houses in San Diego proper. And the reason for that is we want to keep our information consistent. If you look at too many different markets, you'll get things confused. So we just look at the same one. That way we know we can track the trends. So median list price over $1 million, almost 1.1. Median price of new listings is right at $1 million. We've seen this number just climb. Price per square foot, we're going to look at this in detail. Now up to $681. Okay, up to $681 a square foot. This is tracking back 90 days. So we're looking back the beginning of December to now, and you can see we're at $634 back then. Now we're at $681. And so it's good to kind of look at that 90-day, marker on this stuff, or approximately. I think it's 90 to 120 days, something like that. First thing we notice is that the market action index has increased. So this was at 89 last month, and now it's at 92. And this measures the health of the market. It's a super strong seller's market. It's almost as strong as it gets. This got up to 97 or 98 at one point, but it had tracked back into the high 80s and had been kind of fluctuating 87, 88, 89. Now we're at 92. Market heating up. This is because rates have gone up, and we have that frenzy that's caused by that taking place right now. Look at average days on market. That's trickling down. It was at 45 in early December, now at 29. Median days on market doesn't really matter, 7. Price decreases, almost non-existent. We had 24%. That's been cut by 2/3, down to 8% now. Almost nobody's decreasing prices, which means that sellers are getting the crazy numbers they're asking for and then some. There's just very little price decreases taking place. Very little price increases, which I don't pay too much attention to. Look at the relisteds, down from 20%. That's cut in half, only 11. Also another sign of strength. Inventory is down, but not hugely down. We've had dips in inventory. We're going to look at inventory. We're going to look at price per square foot in more detail here in a second. This rent figure is wrong. I looked into this when I first saw it. Essentially what has happened is, because this is median and not mean, what our average, what you're seeing right now is just a lack of reported higher rent prices for high rentals. And so there's a lot more of the one bedroom and studio apartments and stuff like that reporting. And so it's causing the median to be low versus the single family house, because there's so few single family houses that are being rented on the MLS where the data is public, that that's causing this to be off. So I don't know if we can actually use this metric because the inventory has become so scarce. So we may not be able to look at this anymore. Fortunately, I do have some really good rental data elsewhere, which we're not going to look too much at today. Here's the market action index, which was at 87 back in December. You see this? It spiked up to 91, kind of came back down, and now it's heating back up. You see that nice move here, heating back up from just really the month of March, really heating up here at 92. Okay, so let's take a price per square foot here. Look at that. And we talked about this last time we looked at this. The 7-day average tends to it's just like a magnet. It gets pulled back to this 90-day average. That's happened twice since we called that. From here, pulled back up, and then pulled back. Right now, right on top. They're almost the exact same. But you look at that price per square foot, that is the best graph to look at to really see what's happening in the marketplace. You're just seeing significant, consistent, strong demand pushing prices higher. And we are now at a situation where, let's look at this. Let's use a 90-day average, $676 a square foot. Think about that. And then let's do this for fun. Let's go over to condos. Price per square foot, $637. Wow. Now think about the fact that you can build an ADU for $250 or $300 a square foot if you go crazy. That's why that's the best investment in real estate right now, hands down. Hands down. So that's price per square foot. The chart there still looks extremely bullish, looks really, really good. Let's do inventory, which is going to be look at the opposite. Just kind of down. You see the peaks and valleys though. You can really see it here. This sort of the smoothness of this, and you get a little inventory. And as soon as, what you have to notice with this, and what really, really matters, as soon as any inventory becomes available, as soon as you see just a tiny little move up in inventory, the market just comes in and gobbles it up. I mean, just absolutely gobbles it up.
All we want to do is pump you up.
And that's all the market's been doing for some time now. So we have a situation where we are going to find out just how much this market can handle from an interest rate perspective. Rates are going up a lot. I haven't noticed the buyers who are getting in escrow being too caught off guard by it. And that is probably the good news about all of this press. Unless someone lives under a rock, unless someone has a loan officer who's going out of their way to hide this information from them, people are aware of it. So the offers that should be going out, we're still seeing multiples. Those buyers should all be aware of what their payment's going to be with that home. And we're still seeing very strong demand. So far, the increase in rates, we have the frenzy, has not done anything to really move the needle as far as affecting real estate values. Sure, it has pushed some buyers out of the market, no question. But there's so much demand, there's plenty of buyers left for the small amount of inventory that exists, aka this graph right here. Look at this going back, and this is a 3-year chart. So you can see 90-day average back in March of 2019 was 1,008 homes. This is for San Diego City. Now it is 260. So about 25%. That's what we've been tracking for some time now. The 3-year difference in 90-day trailing average inventory has been about down 75%. Down 75%. So that is the main contributor to everything we're seeing here. And unless something changes here, I have to, just out of common sense, have to remain bullish on real estate. Just have to. How could you not? It just looks good. Everything there looks good. It's not great that people are having to pay higher payments and take higher interest rates. That's not ideal. But know this, and please keep this in mind. most people understand the fact that you refinance. Most of the time, within a couple, 3 years, most people refinance. I mean, I think the average time, and I don't remember the source for this, so don't quote me on this, but the last time I saw someone talk about this data was that the average person refinances every 2.7 years. So a lot of people who are getting into these homes with 4-something%, 5-something%, it's happening. They're going to be great candidates to refinance to 3.5% 2 years from now, or a year from now, or 3 years from now, whenever that time comes. They'll be great candidates for that. So if this is what happens, which is what I think is going to happen, if we get this consolidation, we've had this big run up in prices, and now we're just going to go sideways for a while as rates are high, and that sort of eats into, the buyer's willingness to continue to move this thing higher, but there's so little inventory that we just kind of chop around here sideways for a little while, and then rates all of a sudden get better, and then what happens? Again, we see demand spike. The thing is, though, with such low inventory, this might not even happen. We could just kind of change the growth curve, could just get a little more flat, and we could still see growth. That's totally possible as well. The scenario you're seeing on YouTuber, pages and stuff right now, or a lot of people are calling out 20 to 30% housing correction. It's coming. That's possible. It is. I just think it's probably the least likely of all the scenarios. I think it is probably 10% chance for that, more like a 50% chance for this, and maybe a 40% chance for this. It's just the least likely scenario because of the inventory versus demand. And even with interest rates going up. Now, if we do see 8% interest rates, if that does happen by the end of the year, which is that's the trajectory we're on. If you look from where we began the year to where we are right now, if we maintain this trajectory, we're going to be at 8% by the end of the year. And if that happens, then that's probably the 10% situation where we're going to see a pullback in real estate values. But the market will be tested. We're going to find out. We will find out. So let's stay really close. Let's keep a close eye on this. Mortgage bond chart looks terrible. It looks the worst it's ever looked. And you would like to think that once an asset has come in so much, has just come in so much, you would like to think that there's some support down here somewhere, that we're going to see some sort of dead cat candle, just something, anything. And it's extremely anemic. It's very much on this downtrend trajectory, which is super ugly and has no end in sight. So as of right now, there's nothing to be optimistic about as far as rates getting better. There's no catalyst for that. There's also no catalyst for new inventory in this marketplace. Where's that going to come from? They're not building it, that's for sure. So where are all these sellers at? And that question is probably even more important than the interest rate question. We know interest rates are going up, but where's the inventory coming from? If you were to find inventory and put that with an 8% interest rate, we would have problems. Both of those things, though, are probably unlikely. So are we going to roll snake eyes twice? Probably not. But we need to keep a close eye on these things, okay? All right, I'm going to pull rates too. That's on the docket today. We're going to take a look at rates. It's going to be painful. It's going to be painful. So just prepare yourselves. It's not going to be like, oh, wow, that's how, what? No, it's going to be like, oh, wow, really? That's what it's going to be. A couple other things we need to pay attention to happening here. United States is going to sanction over 300 Russian elites and block Russian central bank gold. Not going to do a ton on Bitcoin today, but it's interesting to me that you see the government blocking gold. Everyone's worried about the government being able to block Bitcoin, and they're actually blocking gold. I thought that was funny. Read this. It's a good read. BlackRock, who is the biggest fund in the world, 10 trillion, if you can imagine, 10 trillion. They say that the Russia-Ukraine war is ending globalization, which means that the global trade markets, the way things flow globally, is going to sort of stop. There's lots of trade that goes on between different countries, and if that sort of stops now and everyone needs to be more self-sufficient, or rely on less trade partners because there's trust issues, there's alliance issues going on here, this is definitely inflationary. Okay, this will add to inflationary pressures. This will add to cost of goods. This will add to the cost to build a home. This will add to the cost of everything if he's right. My guess is he's probably right. But he is sitting on a metric ton of real estate. Those guys have so much residential real estate, it would blow your mind.
Damn!
So inflation, better good for them. He also said that the war there could accelerate use of cryptocurrencies, and there's no doubt about it that all of this geopolitical stuff has been sort of a perfect example for why people have been championing cryptocurrencies, which are about to, I think, explode. And I'm not going to get too much into predictions here, but you're just seeing money coming in from every direction. This investor, Katie Hahn, who is a crypto investor, she raised $1.5 billion, which is the largest debut fund ever by a female VC. And she's a stud, and they gave her $1.5 billion to invest in cryptos right now. Okay, there's money coming in from everywhere. The people from Luna are investing $10 billion into Bitcoin, which is what's moving it right now. This was just interesting to me because a lot of people talk trash about Florida, but Florida just became the largest state to mandate personal finance education in high school. Why don't we all do this, please? Can we get with the times, for goodness sakes? That's all I have to say about that. Here's the Bitcoin chart. We were tracking this. We have the two big green channels here, which have been perfect opportunity zones for Bitcoin in this upcycle. And of course, looking at the smaller trends, we just busted through this triangle right here. So we had this downtrend happening. This line was important. It's been broken. It's been violated now. I do expect higher prices from here, even if Bitcoin could go up and it could come back and hit this guy again, or it could even trail off and look like it's getting weak, but then catch the uptrend over here. This is a really good sign. Breaking that is really, really good. So we'll see, of course, what happens. Anything can happen with cryptocurrencies or any investment for that matter. But I like what I see in Bitcoin, and I like the fact that it's moving slower now than it has been. A lot of people are bored by it. But, hey, if you want massive adoption of Bitcoin investments, you don't want Bitcoin going up 10% one day and down 10% the next day. You want it going up 0.5% and 1.5%. And like today, it's up 2.5%. That's what you want to see, because that's the kind of stuff that will get boomers to put their money into it. They will give their money to Goldman Sachs to go buy Bitcoin if it looks like that. Okay, if it's all crazy and all over the place, they're not going to do that. So if you want a 10 or $100 trillion market cap for Bitcoin, you want to see these slower, calmer, more deliberate moves higher. So that's all very, very good. Markets did good today. Dow Jones, S&P, NASDAQ, everybody's up. Everything's green. Everybody's happy. Nobody seems to be worried about any of the macro headwinds. All right, guys. Hey, let's just have a party. Why not?
Playoffs? Don't talk about it. Playoffs? You kidding me? Playoffs? I just hope we can win a game.
I just hope we can avoid a depression. So gold still above 19, close to 2,000. Gold doing okay. We just looked at crypto. Ethereum has been on a tear. Over 3,000 again. XRP back up after it got annihilated there for some time. Haven't really seen the altcoin rally yet that we were expecting. Oil, 112. I think this is probably where oil retreats, but hard to say. Hard to say with that right now because of all the geopolitical tensions. But I do think oil will retreat ultimately from here, but it will be as a sign that things are actually not great in the macro global economy. That's my expectation with that one. Okay, let's take a look at interest rates. Brace yourselves for this. It's Thursday. I wanted to do this today instead of Friday at the end of the day, because Friday at the end of the day, there's a hedge that comes in and that just sort of distorts rates higher than what they really should be. And I will say this, while I'm pulling up the first one here, if you want to get a custom quote, I'm happy to do that for you. All I have to do is email or text me. I just need the loan amount, the purchase price if it's a purchase, the home value if it's a refinance, your credit score, and then whether it's a condo or a detached home. That's all I need to know. I'll give you a rate. I can tell you what our fees are. Nothing. Zero. So I can tell you what our rate is. I can tell you what our fees are and get you on your merry way from there very easily. You don't have to pull your credit. If you know what your credit score is, that's cool. All right, so we're going to start off here. I'll leave that up for just a second while I put this in. We're going to start off with VA today, and we're going to start off detached, high balance VA. All right, let me get this out of here. High balance VA. So 700,000, anything above 647, 200, 780 credit. These are all the same. No fees from the lender. Let's see what we got. Fees out. Okay, there it is. UWM coming through. Such a good bank. I wish I could do every deal with them. 4.125, pretty much a par rate. $150 in lender credit. So there you go. High balance, 4.125. So we're in the fours now for VA high balance. Let's see if we are also in the fours on conforming balance. So we'll just change this to 600,000 now because we know we just need to be under that 647, 200 number. And let's get a feel for this thing. We just do high balance and conforming balance. We do everything as detached. We do everything as 780 credit. There's so many different options. That's why I say get a custom quote, because your rates are going to be different for everyone. All right, conforming balance, CMG's got it. 3.875 with a little lender credit there. Hey, that's not too shabby. I'll take a little cashola for my 3.875, 16 hundo, no lender fees. That's not too bad. You know what? We can probably increase the size of this. So at least in the threes, right? And one of the things I like to see on these is, especially when we're looking at VA, getting closing costs included, you take it up to 4% and get $4,500. It's not too bad. 4.375 give you 11 grand. That's going to cover closing costs for sure at that price point. So those lender credits are still there. We'll know the market's really bad, and we'll know the banks are really scared if these start really thinning out. So, like I said, there's lots of warning signs for before bad things happen in real estate. You get warning shots a lot of times years in advance, multiple months in advance. So we don't need to make any rash decisions. And I've been talking to a lot of people lately, so now we're going to do conventional next. I've been talking to a lot of people lately who are trying to make this decision, and it's just kind of like, well, hey, should we rent? I'm like, well, how long are you going to rent for? Do you plan to rent for the next 3 to 5 years? Because, what are you going to do when rates are higher and prices are higher a year from now? It's the same conversation. So we're going to do conforming balance here. Conventional. No whammies, no whammies. Okay, those are expired. Let's find one's not expired. No offense to Florida Capital. No offense, Florida Capital. We'll look at Loan Depot here. So 4.625 with a nice lender credit, or this is a situation where I would just say take that 4.5 for $308. But still, we're at conforming limit, conventional loan, and we're at 4.5 with 780 credit on a detached. So that just kind of tells you where we're at. We looked at the average rates, remember earlier, and we said, oh, okay, well, the average rates are 4.42. That's going to go up. Next week, that is definitely going to go up. It could see a big jump. That could go to 4.7, 4.8 next week. That's how much that's going to go up. Let's look at high balance here. And this is where it really matters, I think, for most buyers in San Diego, because most people are getting a loan above 647, 200. And so this is the rate that I think is the most important. So 760. Yeah, okay. 60. In there, single unit, cool. All right, this is high balance, conventional. We're not looking at Florida Capital. All right. Yeah, it is what it is, huh? 5%. You could do Florida Capital, but not on a purchase. For refis are fine. Purchases, you need to move faster than that. That's the interesting thing about being a broker. These different banks, they all have their different things that are important or that they're good at or not good at. You just kind of have to know what those things are. So 4.99, hey, not quite 5%, $2,300 in lender credits there. Or you could go for the 4.875 for $730. That's probably the better deal when it all boils down. So still high fours, though. And this is for a really good credit. Let's mind that. In fact, let's do something interesting here. Oh, this is going to hurt my eyeballs. Let's do something interesting here. And let's say someone is unlucky enough to have 719 credit. What is that going to look like? 720 is a big credit threshold, so sorry, it's a loan guy joke. Thing you don't want is 719. You don't want 739. You don't want 699. All right. Flagstar coming through. They've been great on some of these lower credit score conventional deals. 5.375. Yowza. Wow. All right, now we're going to do FHA last. So that was just for fun, if you can call it that. Really just for information. I mean, what range should you be looking at? You know, I can't pull up every rate scenario on here. I already do, like, probably too many. But I figure we got to at least cover FHA, VA, conventional, conforming balance, and high balance. I feel like we have to at least do that. Okay. Percent is going to be 28,000, right? 28,000, so 7, 2. High balance, FHA. Let's see where it's at. Remember, VA high balance is a 4.125. FHA has been a little bit less lately, and there it is, 4%. It's been an eighth less, which is interesting. They're usually right neck and neck, but 4% here. You got a small lender credit, $731. Buy a couch on us. And let's check the conforming balance, FHA. It's amazing. These computers are so awesome, but also I'm constantly waiting on it. So it's like, they are amazing. They do amazing things, but I'm constantly waiting on my computer. Okay. Conforming balance FHA. Remember, for VA, we were at 3.875. Will we be at 3.75 for FHA? Nope. 3.875. So they're the same on conforming balance, but the FHA high balance a little bit better. Nice lender credit there, too. $1,500 for 3.875. So that's where we're at, folks. That is where we are at. And I wish I had better news for you. I do. But it is what it is. It's better to know what's going on than not to know, yeah? Best water in the world right there. Comes out of Arkansas, and you can buy it everywhere. So good. pH 7.3 to 7.7. So good. Such good water. Been drinking that forever. And the wife surprised me with a little bottle here today, so pretty sweet of her. All right, that's it, guys. A lot of stuff in there. I know there's a lot going on. I know there's a lot of fear being peddled out there in YouTube world. I know there's the negative Nancy's are rising up right now. And listen, there are headwinds. There are things going on. There's absolutely no reason to panic. There's absolutely no reason to FOMO. Be smart. Be deliberate. Be deliberate and trust your gut out there, okay? And I will always be here if you need me. NMLS 155010. Got to get that in there. Call, text me if you want to buy a refi. Send me an email, and I will take care of you. Have a great day. I'll see you soon.